Hello, welcome in everyone. Thank you for joining us today. My name is Gabby. I'm with the FlipCo financial team. And then I will let Alesondra and Sami just do a quick intro on themselves.
Hello, everyone. My name is Alesondra Mora. I am the Senior Director of Growth Strategy here at FlipCo Financial. I've been with the company almost 3 years. I've been in the real estate space for a little over 10 years. I started with the real estate brokerage out in Scottsdale and then have worked for various small boutique lenders, larger shops, construction companies, fund managers, kind of just the full gamut of things. But I'm happy to call FlipCo home now. We are based in Houston, Texas. We specialize in fix and flip loans. And had gotten in touch with Sami here a few months ago, and we thought that this would be a great opportunity to do some collaboration. Sami?
Yes, great to be here, and thank you everybody for tuning in. My name is Sami. I'm the head of Originations for Funding Alternatives. We're a private lender based out of Southeast Florida, and we lend up and down the eastern seaboard all the way through Texas. We specialize in heavy renovation loans, spec build, ground up construction, bridge loans for acquisition financing, and as well as fix and flip loans. So happy to be here and looking forward to sharing some good information with everybody who's on.
Awesome. Well, thank you guys for the quick introduction. Let's see, we have 15 people here. Do we want to go ahead and give it a go? Want to start?
Let's rock and roll.
Okay. Alrighty, so we'll kind of start with why we decided to do this webinar today. Alesondra, I'll let you quickly take that over.
Yeah, there has been, I would say personally for FlipCo, we are about 60% broker business, the rest is direct to borrower. And we just have seen this shift over the last 2 years of borrowers wanting to work more directly with brokers just because it can be a little bit more of a one-stop shop. A lender can't be the answer typically for every single project, every single product type. So there definitely is value to having a broker and a good one at that in your back pocket as a resource. So we have seen kind of that stigma, I would say, of brokers kind of being lifted, but at the same time, there is still a lot of people who are wanting to try their hand at it. And let's just say there's some little nuances that maybe people who are newer to this space or a little bit of we've had to navigate some of these murky waters. And then because of that, lenders like Sami and I, we've had to put other safeguards in place just because even though you may be an experienced broker and you mind your P's and Q's, it doesn't mean that the industry as a whole. So I've definitely seen this shift lately of that associations, everyone is trying to put out more educational material just to educate brokers on just kind of things to keep an eye out for and how to work more seamlessly with lenders.
I couldn't agree more. 90%, maybe 85% of our business come through some kind of referral source, whether it be a CPA, attorney, mortgage broker, or realtor. So the purpose of today's call when we were getting together is like, how can we empower a broker to increase the probability of success, increase the probability of a loan closing, and in retrospect, get paid with less headaches. And then so hopefully we could share some information that's helpful, answer some questions along the way, and then see how things develop.
Awesome. Yeah, so very quickly before we get into it, everyone, if you do have a question, feel free to leave it in our chat and I'll make sure to go ahead and let Alesondra and Sami know and we can go from there. But it's going to be very open. So if you have a question, please go ahead and leave it for us. Alrighty, let's get started. Okay, let's start broad. When a broker submits a deal, what's the first thing you're actually looking for before numbers even matter? I don't know who wants to take it over first.
Sami, I'll let you go on this one.
First thing we like to do is we look up the address. Like just want to see where the property is, make sure it's in an area that makes sense. A lot of times we lend everywhere in the United States, most places in the United States. So we don't have a good knowledge necessarily on the exact market. So the first thing we're going to do is pull up the address, do a quick property report, get an understanding of who's actually on title, make sure that, you know, it lines up with what we're trying to accomplish, which is, you know, an investment property in a non-rural area. And ideally, the next thing we'll do is open up a Google Maps, and then we'll type in that address, and we'll do a street view. We'll just take a little walk, a virtual walk down the block, make sure it's in a neighborhood that makes sense. So first thing I would always want to look at is what the property is, what's the subject address before we even get into the numbers.
Yeah, that was absolutely going to be my first answer, address first. That's obviously a very good starting point. I once saw on another lender's website of how they kind of give guidance in their questionnaire that they did was if in Google Maps, is the property in green or is it in gray? And it was kind of an interesting sort of a spiff of in Google Maps, typically the more populated areas are going to be colored gray. If you are in the middle of the woods, they're going to be a little bit more green. So it was kind of trying to call attention to you as a broker, borrowers, of when you look up an address, how does it look to somebody who's not involved in this transaction of is it in the green or is it in the gray? So definitely a different variation to being in the green, I would say on the lending side, but it definitely matters of we all cannot be experts in every single town. I'm from Chicago, Northwest Indiana. I lived in Scottsdale, Austin. I'm here in Houston now. I do not know these small towns in New Jersey or Missouri or, every suburb in Atlanta. So there are things that you can do to kind of set the address up for success, even if you do know it's a little on the fringe of what is attracting people to that area. Is something new coming? Is there a college? Is there something that we wouldn't know off the bat as just like a 30,000 foot removed person about this particular area where we wouldn't just read the address and look at the broker or send an email back like, why would you even submit this to me? Like, what are we thinking?
Yeah, and I would even go like a step further after the address. On our side, we really like to break it down into two initial due diligence. It's the property, and then it's the borrower. So as a broker, to be a stronger broker, you can pre-qualify a lot of the initial hurdles to make it easier to get a term sheet, to get it easier to make a guidance for a loan product that your client is looking for. And the basic, it's really a couple of inputs. On the property side, as is value of the property, all estimates, it doesn't need to be exact. Estimated as is value, estimated renovation budget, and estimated after repair value or completion if it's a construction. Those three variables right there will tell us a lot about the deal. You want to make sure it's profitable for the investor and that it makes sense on paper. And then after we look at the property, from the borrower side, on our pretty straightforward, estimated credit score, again, doesn't need to be exact, we'll validate that. But estimated credit score, estimated liquidity, and have they done this before? With those 6 pieces of information, we could put together a relatively accurate term sheet that can help you get your deal closed.
And I will say something that's not even for, the initial question being, what do you look at of a deal before even looking at the numbers necessarily? I do pay attention to how a deal is submitted to me. Was it the mass BCC? And it doesn't appear that it's even specific to me. And this probably went out to 100 different people in a distro list. I do take that just as a data point. That is something to consider, especially when we are getting hundreds of requests that we do. And, is it somebody who actually has a broker contract with somebody, or is it somebody who's just shopping out something that they saw in a Facebook group as a potential lead? So that is something small that I do pay attention when I am building relationships with brokers of how did they submit it? Did they go through the steps to actually fill out the quote, give us the initial information like Sami said, or was this just a blind kind of shotgun method of like, let's see who responds sort of a thing? So that's just something to know.
Awesome. Great information. Well, on that note, we have our next question. So the next question is, we all make money saying yes. So when a deal gets a no, what's usually behind that decision? I'd like to go first.
I mean, I would say typically for us, we regularly track we call them DNFs, do not fund, what our categories are. And right now, the number one is a lack of comps. So seeing a lot of that. When an investor could have gotten a deal, maybe they got an investment packet, and at that time, the comp still would have been in a 6-month range. But then it took them 2-3 months to actually get everything together. Now those comps have timed out, and we can't ignore the seasonality of the year. So if you were going back and were able to pull comps at the height of the market in the summer, that's going to look very different than if your property's coming online in December. So it's even the little nuances of like what's going to be available to you to even pull comps within your time frame. So it is important of whoever you are submitting to, knowing their guidelines of how far back will they go. FlipCo 6 months, because we are primarily the short-term fix and flip. So it's keeping in mind of, it's not just, well, my DSCR lender will go back a year, but it's, well, how far in will you be by the time you're done? So let's say we're pulling comps from today. So it's March 24th. So if we went back 6 months and it took you 6 months to complete the project, well, then we would have been at 12 months from the comps we initially pulled. And if you had gone back further than 6 months, you would have been outpriced anyways. So it's, the comps is an issue. And I think I shouldn't say an issue, it is a barrier, or you should say an obstacle that we love to navigate with our clients, of always getting the question of, well, what about these comps? What about these? So I'd say then it's also understanding the underwriting process. You know, does the lender use third-party appraisals? Do they use their own data software? And then if, as far as for valuations, what do they consider like for like comps? And every lender is going to have different answers for that.
I think that's spot on. There's different levels to being a broker, and it's really, you could save yourself a lot of time and actually by putting your best foot forward, especially on an initial inquiry. You have a lot of information available online. If you literally type in the address on Zillow, you could look on that area for comps that have sold in the last, we call it a year, 2 years, 3 years, but we look at about a 12-month look back period. We want to see comps in the area, ideally within a mile radius, 2-mile radius, and even 3 if we need to, if it's a unique property. But if you go on Zillow, you should be able to find a good amount of comps. The second thing I do right after looking at the Google Maps is literally open up the Zillow or a prop stream or a house canary, whatever valuation metric you want to use, and just type in the address to see what kind of properties have sold in this area. Some things that will be a little bit hairy, we like to look at median home prices relative to, in that area relative to the subject property. So, we understand that a lot of this is going to be a value add, and areas are going to be getting gentrified, for lack of a better word, or improved upon. But we will happily look at something that's maybe 200% or 300% larger than the median home price. But if you're in an area where the average home is 500,000 and you're looking at a property that's 1.5 million after repair value, that's also going to be something that you want to get ahead of as well, because for your borrower, your client, they should also know, if they don't, that, hey, you're going to have the nicest house on the block. Not necessarily a problem, but something that you want to be aware of going into the loan.
And I do think the nicest house on the block matters, of something that is often forgot. Obviously, getting your acquisition loan and construction, that's kind of part one of the piece. And then whether if you're going to hold it, refinance it, or if you're going to put it out on the market, it's keeping in mind what's going to be that second takeout. So if it is going to be selling it on the market, if you're the nicest house in the block, depending on your price point, when you're more in, the 300K range and sort of that lower 100,000s of the people who are going to have to qualify for those homes, if the property cannot appraise because you are the nicest in the neighborhood, there isn't necessarily those comps to get to the value. Those likely aren't going to be borrowers that have the liquidity to come to the table with an extra 5-10% down. So it's always kind of something of taught of like being middle of the pack in real estate is not a bad thing.
Mm-hmm.
It's not. All righty. So let's talk about guidelines, and let's kind of dive deep into that. From a lender's perspective, what's the biggest misconception brokers have about guidelines? I'd like to take this one.
I could take a crack at that. Guidelines are there to guide you, let you know what is available, what's not. We like to be in a position where we know that some things are out of the ordinary, where if it's not in, I like the idea of yes, comma, but. Yes, we can do the loan, but if it is the largest house in the area, we're going to reduce the initial leverage just to make sure that we're protected. So the guidelines are there to give you guidance on what loans have a higher probability of success, and the more inside the guidelines they are, the more accurate the pricing is going to be with less exception requests. I mean, again, a lot of files have exceptions. That's totally fine. Credit, property, borrower, etc. Guidelines are there to kind of show you what a down the fairway loan looks like. And we know, especially in this space with how many people are involved, how many lenders are out there, how many brokers and properties are out there, that not everything is going to fit the box. So we like the yes, comma, but approach. Yes, we could do a loan, but because it's outside of this that we like, we're going to do this.
Yes, I would echo that guidelines are exactly that. They are guidelines. They are not set in stone. I do love when I have my own guidelines quoted back to me. Well, per the loan program, you can do this property. And it does go to the, well, yes, but you had 3 other things that didn't fit the guidelines. So I think the biggest misconception about guidelines is that they often just aren't read. Or that there is an assumption of, if you loosely know guidelines of some lenders, that it's just a universal application. But everyone's risk tolerance is different. And if you truly want to hone in of having, of being able to quickly select a lender that will be a good fit for your borrower, having those handful of lenders that you do know their guidelines like the back of your hand, like who to place like the low credit ones with, and I will say FlipCo gets a lot of that because we don't have a credit minimum. So, we understand that will attract a certain type of deal and we have to be prepared for that. But you have one for your jumbo loans, you have one for ground up. So when you understand the guidelines, you can navigate a deal much faster, get that approval much faster, and then you're beating the curve for then other potential brokers in getting a term sheet or getting that pre-approval and things. So when you actually take the time to understand the nuances of a lender's guidelines, it's only going to serve you and your business model.
I
Right.
like that.
Correct. Okay, so how much flexibility really exists inside lending guidelines, and what determines when exceptions are possible? That's a good question.
You want that
Guidelines are
one?
guidelines. Yeah, guidelines are guidelines. We often do say it's a case by case, because I could name 10 different scenarios off the bat of why we've made exceptions. One, experience. If it is an experienced investor, they have a track record to speak of, where we'll say, be careful how you define experience. Just because you were a successful investor in Kansas City does not mean you were going to be a successful investor in Tampa, Florida. That's not, it's a totally different market. It's a totally different buyer pool. However, if you told me you're from Tampa and you go there every other month, now that's a different conversation. So experience is a huge leverage point of if you've successfully done it before, because you can literally point at your track record. I would say credit definitely impacts. I mean, regardless at FlipCo, we don't have that minimum or pull it, but it is still a number that is a reflection of how you pay back your debts. It is a data point nonetheless. And then I would say, from keeping in mind of a newer investor versus being out of state, have you done it out of state before? And then just the size of the project. Just because you took down a 20K rehab does not mean that you're ready for the 250K rehab. So I think it's the consistent like for like experience is the largest leverage point for us, and when we're getting comfortable in making exemptions.
I couldn't agree more. I like to say that the trifecta is credit, liquidity, and experience. You don't need to have all 3, but ideally you have 1.5 of the 3. And if experience being the largest weight. If your client has demonstrated their ability to execute on the scope of work or their business plan, that speaks for itself. Because credit, especially with our investors, it's a data point. To your point, it shows how someone manages their life. It shows, we like to look at it to see that they're able to pay on time, get their ducks in a row. But we totally understand having high utilization, being late on a payment here. It's got to have a story. It's got to make sense.
So what parts of a deal tend to raise red flags early, even if the numbers look good on paper? This is another good question.
Liquidity. I'll say I have that one in my back pocket.
Who's ready?
Yeah, liquidity, a high value or a high amount rehab with lack of experience, and they want to self-manage it, and they're out of state. You just stacked 4 exceptions on top of each other as far as having the confidence that the borrower is going to be able to pull that off. But liquidity is the biggest one. I mean, you can have the greatest investment property on paper, but if you don't have the liquidity to carry it through to completion, it doesn't matter. Quite frankly, because then it's a sitting at that point, because you can't execute, you can't front those draws. That's another very important thing. The lenders that you select, understanding their draw process. How quickly can you get funds? What does that look like? Is it finished work? Will they front draws? We do not front draws. We go off completed and paid for work. But there are some shops that they have their own guidelines for that. Do they require third-party inspections? Kind of, there are additional things that can kind of keep you from there. But I would say liquidity, hands down, it is a low-grade red flag. Just a consideration, and I know we'll probably talk about red flags a little bit later, of when we already have 3 exceptions and now we're bringing in a gap lender. It just gets a little hairy early then.
No. We like to structure win-win-win deals. It's got to be a win for everybody. It's got to make sense. I think one of the liquidity is a very important part. A lot of times, borrowers tend to forget there are other costs. You have insurance, you have taxes, you have carrying costs along the way. So you need to make sure you can comfortably manage this project without it affecting your personal life. At the end of the day, this is an investment. You got to make sure your family's okay, your home is okay. Whatever is going on, this is an investment property. You want to make sure that you're not going to find yourself 2 months, 3 months into this stressing out more than you need to. There's already enough stress factors in the game as it is.
I mean, and that's the thing of, as a broker, you definitely should be encouraging, whether a lender requires it or not. Borrowers should always have contingency funds. In real estate, it's not if something's going to go wrong, it's always the when. Something didn't get installed properly, an inspection didn't go as planned, supplies got delayed, your listing date got pushed back. The liquidity is just a very big piece, just because, the reality in life is, cash is king, and cash can solve a lot of problems sometimes. And so of making sure that your borrower is set up to actually support the project. And that is something that we're seeing a ton of right now, is a lot of creative pulling of funds in order just to meet the minimum reserves. And we aren't even including all of the costs. Like Sami said, like, we don't have title fees in our term sheet. We aren't including all of your monthly insurance payments. We don't include your life stuff that just happens. And as somebody who's extremely injury prone and has basically a track record of only going 90 days max without maybe ending up in the hospital with stitches, like, I gotta have funds for that, and I can't dip into my project to fund the stitch, visit for the quarter. So it is, I think that's the biggest argument that I am seeing from a lot of brokers and borrowers. It's just a few grand. Well, if I also know that you have other active projects going on, well, if you're barely able to meet the liquidity requirements for this one, how are you going to support multiple on top of that? And I will say an interesting one was, we had a bank statement submitted that it was labeled emergency funds. And I was like, I'm not loving that we're using the emergency fund bank account for our minimum reserves. So there are like little nuances like that of, I'm not going to deny a deal for that, but you've now just shown me a bank statement of what you're using for your project liquidity as an emergency fund.
Definitely something that's noted. And then I would also say we, on our term sheets, and after a couple of the quote unquote surprises where investors were like, oh, well, that wasn't on the term sheet, it's on the HUD though. We break it down because it's just something that insurance, we just like to assume on a conservative side, 1.5 of the loan amount or the purchase price for title, you have recording, settlement fees, depending what state you're in. Filing in Illinois, recording and mortgage is a little bit more than in Texas or Florida. So we like to put a blanket about 1.5 for the title, about 1 point for insurance, just to be on the conservative side, because these are costs that are going to be on the HUD that need to be paid for. And it is something that is important. And a lot of times, you see these really good deals, and the borrower's trying to sell it hard, the broker's trying to sell it hard. And, at the end of the day, you got to make sense on a napkin. It's not rocket science. It's got to make sense. And you don't want to be in a position where someone is having to tap into their emergency fund or hinder too much. I mean, sometimes, it happens, and sometimes deals are tight. If the borrower has experience, it kind of makes sense. But that's what we talked about earlier, like 1.5 out of the 3. So if you don't have the experience, it's good to see a good credit and a good liquidity. If you have the experience, we understand that credit and liquidity might not be there, but that's definitely something. I say another thing that gets kicked out pretty fast is rural designation. Not necessarily because we're like anti-rural, but we gotta be in a market where there's active sales. You gotta be in a market that's close to a Walmart, that have decent gas stations, a good grocery store. So some simple tips for brokers out there: when you take on the project, if you spend 10-15 minutes doing a USDA search, type in USDA property search, it'll tell you if the property is in a quote unquote rural area. CFPB to tell you if it's in a rural area, and it'll just save you time and heartache because you're going to be spending time trying to put this deal in the right lender's hands to get closed, and you could avoid a lot of headache by getting ahead of that. And in those situations, again, it's yes, it might show up on the USDA, yes, it might show up on CFPB, but we also are pretty logical. If you kind of see that you're in an area that's up and coming, you see a lot of houses being developed, the big builders there, that changes the equation a little bit. But knowing your property's area is pretty important.
Awesome. Well, on that note, Sammy, I know you were mentioning tips. So let's help our brokers build a stronger file. So what separates a clean submission from one that's going to create back and forth? Who would like to take this one?
I think we talked a little bit about it earlier, and that's really spending that extra 5-10 minutes on that initial call with your borrower. That first call, you get the most information from the borrower, and it tells you kind of how this, because these loans, I mean, we could get loans closed in 2 weeks, sometimes faster, but that doesn't mean it takes you 2 weeks. You might have been shopping this deal for a couple weeks. You might have gone through different processes. I feel like you could avoid a lot of it by capturing those 6 points that we talked about earlier about the borrower and about the property. And then you could take another step forward by showing that you've done a little bit due diligence yourself. Even though you're a broker and it's not your money, well, you've shown to the investor, hey, this is an area, but this is happening. So I think spending that extra 10-15 minutes with your borrower earlier on to get the facts and the storyboard straight will put you in a stronger position. I mean, and just asking questions. Hey, what is your credit score? If they tell you it's a 650, well, why is it a 650? All right, well, what happened there? Or, okay, have you done this before? Yes. Okay, learning a little bit about the project. I mean, sometimes you'll have someone who's had a foreclosure or a list pendants filed. Really understanding, the earlier you're able to get that information and use it, we could then formulate a more accurate term sheet and then get ahead of potential hiccups, because we will find out. We're going to do a background check. We're going to look at LexisNexis to see, any outstanding litigation, any lawsuits, any foreclosures that are active. These are things that could save you a lot of time. At the end of the day, time is the most valuable resource, and you want to make sure that you're spending time and have a high ROI on your time. And I think by doing that initial 5-10 minutes could save you a lot of wasted time spinning your wheel.
Absolutely.
Yeah. I think the actually speaking to the borrower, especially in a digital age, is key. And I understand not everybody is exactly a phone call person, but I think of however you have your initial intake questionnaire and form, just making sure that it actually covers at least relatively the majority of the questions that any lender will ask on their application. I bet if you put Sammy and I's application side by side, you probably have 95% of the same questions. Each of us have like small little variances that matter to our specific shop. But if you incorporate those into your application, you at least then know you're set up with the information that can allow you to pivot to any lender that may have. And it is a smaller lift to get that additional info from the borrower. And then I do just want to definitely echo what Sammy had said about we will find out. Especially in today's day and age, there is a plethora of resources, online databases, public record searches, cities, especially because we don't necessarily focus. And again, going back to the rural comment, we're going to lean more towards a major MSA, staying within those suburbs. So those are typically going to be tech-enabled counties that are advancing their reporting every single day. So it is much better to get ahead of a previous bankruptcy, a previous foreclosure. Just paint that picture, if it is actually creating a formal LOE or if it's just getting a summary from the borrower, it's just going to frame our mind a lot better than finding out on our own after the fact. And then that's when we're starting to dabble with, we're now zoned in on a commission that we're now going to possibly lose out on, $5,000 or more. And I'm just now trying to make this deal work. But I could have told you no 2 weeks ago and you could have been on to your next deal.
Okay, and then another one thing I see a good amount of, the broker to broker transactions where you see a little bit of a daisy chain. I mean, as a broker, you have a strong network, you have a lot of relationships out there. The deal might not always be your deal per se, and that's not a problem. But that's something that as a broker, you need to take ownership of earlier on and have control. You need to decide if the broker the broker that you're working with is having a hard time placing this loan and they bring it to you and now you're brokering this loan as well, a couple things that you should try to get ahead of from your point as a broker is being clear on the fees, expectations, because you don't want to be 3/4 of the way in and now trying to cut here, cut there, going bickering with your financial partner, asking the lender to cut fees, etc. Having that initial upfront conversation with your broker, having that up and trying to push for getting the storyboard straight, because but sometimes I see a lot of it is the borrower ends up getting fatigued. I mean, they're getting beat up. This is not what they necessarily signed up for, and they might bring you a deal that you're the final straw, and you bring it to someone else. So you really want to make sure, especially on the broker-to-broker transaction, that you have the storyboard straight. Why didn't this work with the other lender? What were some of the red flags that they identified? And really being upfront with that increases the probability of success. I mean, we all like execution certainty, and no one gets paid unless the transaction closes.
Right. Go ahead.
Oh, I was gonna say, again, if we haven't noticed, of the comment that I've said a few times of that, of basically being aware of what you submit. We can't unread, unsee, unknow what we know once you submit something. And if you do submit a rehab budget from another lender or, a different template that is very clear that you placed this somewhere else prior to bringing it to us, the first question is going to be, why did that particular shop turn it down? So definitely be cognizant of what you are providing. I think all of us lenders say, just give what we ask for. Obviously, you can provide some additional color or documents to validate experience, but just be cognizant of what you are submitting. And I would say, especially if you have transaction coordinators, processors, make sure that they at least have loose knowledge of how to pre-flight documents, because that is what causes a lot of delays, is just documents that are submitted without even being looked. Like, oh, they gave me a copy of the rehab budget, I submit it, but none of the line items are filled out. We have missing dollar amounts. Now we just lost another day and a half. So that's even the simplest thing. Just open and read what you're being sent before you submit it to us, because then that's going to feed our frustration of, you could have opened this yourself and you could have done this and we could have already been in underwriting review, but then now you're coming at us that we're coming up close on closing. It's like, but you've had this contract for 2 months. So I think that's another big thing of, don't then put your expectations of tighter closing lines on your lender, who then is just trying to work with you. So it goes back to all the things that we have said of how to submit that information in a timely and a concise fashion. Anything that's given piecemeal is always just going to cause delays and then possible miscommunication.
We do have 2 questions. Would you guys like to answer those now, or should we leave that to the end?
No, we could take those. Mark, okay. I will take that, because that was a comment that I said. Lenders drop fees, ? Yes, comma, but we're gonna we don't like to have fees get in the way for a deal getting closed. What I do see is a lot of I guess misunderstandings from brokers, which is especially when it's a broker to broker transaction, where you have another person involved and everybody has their hand out to want to get a cut of it. And I think it's being realistic, and there's also we all work in this space day in, day out. So for us, it's like another day in the office. But for the borrower, it's not going to sit well with them if you start stacking fees on there. We like to keep it as clean as we can. The standard, you have an origination fee, you have a processing fee, and you have an underwriting fee. Now, we're going to have a broker fee, and it should be in line. Our term sheet will have everything spelled out, and similar to your term sheet too, it will have everything spelled out. So when it comes to dropping fees, it's not necessarily of, we're going to cut this or cut that. We're going to try to structure a loan that it makes sense for the borrower and for the broker to get paid as well. However, to be very candid, it's very frustrating working with brokers that, especially in the residential market, where they could get that 2.75% in YSP on a 30-year mortgage, and now they're getting into the private lending space, and they're also expecting a 2.75% fee. That's not realistic. I mean, you could try to, but I don't know how successful you will be in closing loans when you're trying to maximize fees. We like to have a rule of thumb where, to have a broker fee be greater than the lender fee is going to be a yellow-orange flag. So unless it's a really, really good deal on a silver platter, I mean, it's tough sell to expect to have a broker get more in transaction fees than the actual investors putting their money into it. Does it happen? Sometimes, but best practice is to really, if the file has a lot of work and a lot of stuff going on, well, it's going to be reflective of your fee. And if you're doing a lot of work and you put together a beautiful package on a silver platter, well, then you deserve to get your fee. But at the end of the day, it's the borrower paid compensation. This is not a lender paid compensation. Now, we do work with, as a wholesaler, with some lenders where we do participate and help them by being a wholesaler kind of transaction, and we can get creative in the fee structure. Again, we don't want fees to be a reason why a deal doesn't get done, especially if it's a good deal.
I'd say from the fee perspective, again, every shop is going to be different. So the understanding the why of the fee, and then you can kind of navigate of maybe what its potential flexibility is. For example, FlipCo, we just have our origination, like to think of it as an all-inclusive resort. It just encompasses everything. So we don't have a processing or underwriting fee, but that's also because we do in-house underwriting through desktop appraisals. However, again, there are other than risk mitigation levers that we pull. So we do, we started a higher interest rate than some other introductory shops. So there's things that all offset the other. So it's not, it'd be lovely to find, the one-stop shop that they have the lowest rate and the highest leverage and absolutely no fees, and I can charge whatever I want as a broker. So it's just understanding of kind of how to pull the levers of like why certain fees or parameters are in place, and then what those are used for within the lender. But I'd say the immediate question typically is if a broker is coming back asking for a fee reduction is because they have priced out too high to their borrower. So if you're charging 2% and a processing fee as a broker, and then you're looking to the lender of like, well, you need to drop your origination, the borrower saying it's too high, but then you're not willing to drop anything, well, we're not being very collaborative then in this conversation. And I think the key is to think about and remember that a good investor, they'll come back to you, 5, 10, 15 times. And so why burn it over a few $1,000s on one transaction? Of always keeping in mind that long-term relationship with that investor. And Sami is 1,000% right. If you are providing a service, any of us do it every single day. Like, we are willing to pay for something that we feel we're getting value out of.
On that note, we have another question. It says, how often do you update your budget and guidelines? Let's take this one.
As far as budget, we just have a template that's used. I'd say it's been the same one since I've been at FlipCo for 3 years. I'd say typically lenders aren't exactly updating their budgets per se. It may be getting client feedback of, hey, this line item was a little confusing, or maybe we want to break something out. I don't know of too many shops that are like regularly adjusting a budget itself. Guidelines are going to shift with how things happen. So typically an additional guideline is created because somebody or something happened. So I kind of look at it as of the warnings that are on the plastic storage bin. It has the baby icon and it says, don't put a baby in here. And it's like, that's there because somebody did it. So when we release new guidelines, and it may seem a little tedious or a bit much, but it's because something happened. So something happened that is now making us feel it's important enough that we now need to have this new guideline, guardrail, whatever that might be. But I'd say we're doing it on an ad hoc basis of if something has happened that we have seen has had a significant impact on borrower success, or I'd say right now, I've mentioned it, we're personally seeing a lot on the liquidity side. So we're tightening up on our minimum reserves and liquidity guidelines just to provide more clarity to people of how we accept those. But it's going to be mostly driven by what the market and borrowers and brokers are communicating back for what they need more clarity on. So I'd say it's not something where you're getting new guidelines every week by any means. And this varies very different from a DSCR lender who's giving you matrices. That's a totally different ballgame from general guidelines.
I'd echo both of those. The way I interpreted that question, Jarvis, is from a rehab perspective, budget is what I'm assuming. But budget templates, will accept different kinds of budget templates. But the thing to really note on the budget is that's what's driving a big portion of the loan. So the budget that is submitted is the budget that's going to be used to do a potential feasibility report. It's going to be the budget that's going to be used to estimate an after repair value. It's going to be the same budget that's going to be used to dictate the draw. So it's really, really important that that budget is, clear and is a reflection of the work that's going to be done. A lot of times, I'll speak with borrowers when I'm working with them directly, and oh, well, I don't need that much money, or oh no, I'm going to fund this out of pocket, and then 3 months in, it's like, oh, can I get a reimbursement for the windows that I did? You pull up the budget. Well, hey, we didn't put windows and we didn't put a sliding glass door there, so I can't get you that money. But if we would have put it in from the beginning, well, then we could have gotten you that money. So in terms of an actual renovation budget, though, once those are submitted and get the ball rolling, once the file closes, it's written. It is what it is. It's written, and that's what's going to be driving the loan process. But from the time we start, we could go back and forth. We have construction team on our side that will help review it, make sure you're understanding and aware of it, identify potential items that you missed. So you didn't put a dump truck fee, you didn't put a demo fee, you missed this. I mean, do you want your money back for that? Or and then I think another big factor when I talk budget with borrowers directly is the more robust the budget, the higher the potential after repair value is, which also drives the loan. So you want to make sure that when you're doing your budget, that the borrower's budget has a good ROI. So if you're doing, for instance, in this case, the windows, because I was dealing with this earlier this week, it's like when we first started and I was working with this borrower, I wanted him to bolster his budget more so that he could get the higher after repair value, and then also so he could get his money back. Because I knew he was going to be spending more than what he was saying. And so it just leaves for an awkward and a relatively disappointing conversation. I'm like, I would love to, nothing would make me happy than to get you the money that you spent, but because we didn't factor it into the loan, I can't. We have kitchen cabinets, flooring, roof, landscaping, and then that doesn't fall in these, so I can't. So that budget really, once we get the ball rolling, that's what's going to be driving the ship. As for program guidelines, similar to what Alesondra said, DSCR pricing gets updated on a daily basis. For most of these private loans, things that might be flexible on program guidelines is like you said, market stuff. But for the most part, these are 12-month loans, so investors are aware of it, lenders are aware of it, so they don't really change too much.
Awesome. Okay, Sami, I know you mentioned this earlier about deal fatigue, so I kind of want to hit that because I know it's an important topic. So this question is, we often see the same deal submitted by multiple brokers. Why is that a problem from the lender side? Who would like to take this one?
It shows us that the deal's been shopped around. And we like to be very upfront with the broker that's bringing us, hey, we've seen this deal and we've actually issued a term sheet. And a lot of times, hey, we've seen this deal, we actually passed on it because of A, B, and C. A lot of times, especially with the broker-to-broker transaction, you don't know where the other person has taken the deal. You don't once the deal goes out, I mean, it's the wild, wild west out there. So the deal fatigue is a real thing. Brokers that, again, it's really, we're going to protect the relationship with the broker. And it's a tough situation when you find out that two brokers bring the same deal in. And at that point, it's like, who's going to bring back to execute a term sheet and get the ball rolling?
I'd say it comes down to transparency a lot. We kind of go through waves of it, of seeing a hit and things of that. But I'd say that also comes down to where you get your leads from. Were these direct submissions? Was it a Gen Pop kind of a thing? Like, are you just pricing out? So just be aware of that. You already know off the bat that you are competing with others if you don't have a signed and executed broker agreement stating that they are going to move forward with you. However, I know, of course, you want to present options typically to the borrower before they may want to commit to you. But I'd say transparency is key. The biggest thing that I have seen where things have blown up a little bit, especially on the broker to broker sort of daisy chain situation that we've touched on a little bit, is misrepresenting that you are a direct lender when you are a broker. So that's when some of that communication can break down if they think they're going straight to the source, but then that broker just then ended up bringing it to FlipCo or, funding alternatives. Like they just end up bringing it to the person who is ultimately going to be that funding source, which I guess is a compliment to each of us of, oh, I guess they knew this one would be a fit for us. So kudos for that. But I think transparency is a very big part of that as a broker, of how you're shopping it, paying attention to where you're getting your leads from. What is your pre-vetting process on that side, just to not, fatigue your own kind of time in submitting that to multiple. But definitely, if it was something that we've seen shop several times, it's a red flag if we never made it past a certain point that there might be something off with this deal.
Right. So on that note, what does transparent representation look like when it's done right, and why does it matter long term? Take this.
Yeah, you got that.
Yeah, I was like, it's gonna look very different for every brokerage. Because some brokerages, like, they may have a small fund and they may do some table funding, and I understand of wanting to kind of seem like the one-stop shop. But when building long-term relationships, it's no different than why we pitch, like, okay, why you should work with FlipCo, why you should work with funding alternatives, why you should not go to RCN as like a huge mega shop or something like that. We all have to kind of have our value pitch and explain, but then a big part of it is that building a relationship, picking up that phone, having that phone call. So I think it's a lot of it is just having the conversation of, these are the services that I offer. Because I am a broker, I can provide these things. And having a very clear and executed broker agreement definitely protects you. And then walking the borrower through that, I would say, don't try to sneak in some extra clauses or some crazy lock-in 5-year sort of a thing where then you're trying to battle someone. Because ultimately they're going to probably not see the value in the service if they feel like they're just getting nickeled and dimed and a little bit of a bait and switch. So it's going to look very different for everyone depending on the type of brokerage that you have in place, of how you want to present that. But ultimately, I mean, we do client surveys after every single funding, broker deals, and direct to borrower. And the number one feedback that we do get when it is a broker of, I never knew I was brokering, I didn't understand the process. So I think the biggest part with transparency as well is, if you are presenting multiple options to a borrower, that you are very clear with like what the next steps are after they leave your care, because then it's a much easier handoff and a little bit seamless. And again, that's why they might come back to you again for that refinance or for the next one to kind of find that placement. So I think sometimes we forget about the handoff part, and it's just like, well, now it's in the lender's hand in servicing. But that handoff is definitely a very hands-on and easy lift for you to still stay top, I would say.
Yeah, I mean, with brokers involved, I feel like the most important piece is that, because this is your client. You're the one who's going to be speaking with them, giving them updates, letting them know, hey, this is what happened here, this is where we are at the process. So I guess having that transparent conversation on timeline and expectations is very important. Sometimes I get thrown on calls with the broker, wants me to talk to the borrower and ask them questions, and the borrower is just like, this isn't what you told me. This is, we started out at 75%, and then we're at 60% now, and it's very uncomfortable. And I feel bad, because the broker kind of put himself in this position or her in this position by over-promising on something to win a deal and to get it going, and it ends up biting them at the end, tarnishing the relationship for sure.
Well, now that we are hitting the final 10 minutes, let's go ahead and close it off and leave our brokers here empowered. So if a broker took one thing from today and applied it immediately, what would improve their results fastest? Let's answer this.
I would say trust but verify. I sit on the AAPL fraud steering committee, and that is just a huge topic right now. And I've participated in a lot of educational courses, but I think this motto takes you through experience, liquidity, just about anything in the gamut for what structures a deal is trust but verify. Just live by that motto of, we all kind of, you have the scenario of there's, the truth lies A, B, and C, and somewhere in between there, between the different parties. So we all even are a little self-biased from ourselves. I mean, the three of us can do a recap, and I'm going to tell you what, we're going to have 3 different versions of this webinar. And it's not going to be from any malintent or anything, but it's just, we are human and we process information different. But always trust but verify, and just know that as a lender, we will validate that as well. So it's not just, "Oh, okay, well, you said so, so we're good here."
I'd echo that. I'd also add, spend that time. I mean, put yourself in the lender's position. Ideally, you're establishing a good relationship with a capital provider, and you could have a strong, strong relationship where exceptions are made strictly on your relationship with that capital provider and the work that you've done together. So if you put yourself in the position of what would the lender ask, what are they going to want to see, getting ahead of that, it will pay dividends for you, not just monetarily, but less acid reflux, less headaches. And I think the biggest takeaway on my side that I could share is just spend some time, that first 10 minutes, 15 minutes that you're on the phone, gather as much information as you can, open up a Google browser, and just do a little bit of due diligence before you start spending time and plugging in. Nothing wrong with using a chat GPT, but making sure that you're putting in the right information, summarizing the deal in a way that makes sense by gathering that information and doing that upfront work.
Awesome. So what's one habit, I know it's kind of touching on what you just said, Sami, what's one habit brokers should stop and one they should start to build stronger lender relationships?
One habit that they should stop and one that they should start. All right, go ahead.
I think stop using chat GPT, I think is a good one, Sami. So that's your stop.
I don't mind ChatGPT.
It's a tool. It is a
I use it
tool.
all the time. But garbage in, garbage out.
Yeah, garbage in, garbage out, absolutely. But I would say a habit that I would say to stop, and this kind of is a piggyback off of if you have a transaction coordinator or a processor, is read an email in full and make sure that you respond to the points as a whole. Again, I'd say typically, especially if there's a daisy chain of information, there's a loss. And I would also say kind of an echo of that is I highly recommend do not just copy and paste my feedback to you as a real estate professional and then just give that to your borrower. So I'd say do a little finessing of what that feedback is about a deal or a document that has been provided to make sure that it translates to them a little bit smoother, because I have seen just copy and paste and I'm going to use a much different language to a broker than what I would have used probably to speaking to their borrower directly. So I would say as a broker, do that service of, take a second, actually read through what's being requested, and then make sure you're properly explaining to the borrower so that they understand the why behind it versus starting off a defensive tone of like, why am I being questioned about this? And I've just seen too many times a copy and paste. It's just the copy and paste. And that sort of goes back to what I said of just read through and make sure everything was answered and addressed, because we're just going to continue to have a back and forth then. And that's when your borrower is going to get frustrated. They're going to feel like they're getting pestered for the same thing for the fourth time. And that's when you're going to get frustrated because we're having delays. So that would be my habit to stop.
I think that's a good habit to stop. And I think a habit to start would be to, I think, and I know I sound like maybe but take a step back and, you're a mortgage broker and you're not going to get paid unless the deal closes. And how can we have the highest probability of success and ensure execution certainty? It really starts with you because you're the gatekeeper. And you're going to have the information at hand. And it also echoes what Alesondra said earlier, trust but verify. Quick ways to get blacklisted: altered bank statements, fraudulent appraisals, altered title documents. Like, it's not worth it. It's really not worth it. We could get through a lot of these issues with transparency and communication. We all use these very sophisticated technologies that's outside of our scope of knowledge, but we run through documents through AI to make sure that they're not been altered. And 1 in 100 will submit an altered bank statement. Very easy way to get blacklisted. I mean, and as a broker, it's easy to tell yourself, oh, let me just not read this document and forward it along, but you are the gatekeeper. And if you see something that looks fishy, you can ask about it and preempt it. You don't need to liquidity is a big important topic, but altering your bank statement, not worth it. And at the end of the day, we're all in this together. We want to make sure that, we close transactions. We want to make sure that your clients are happy. You are our clients. I don't consider the borrower my client. That is your client. You're going to bring 10, 20, 15 deals to us a year. Your borrower, you're going to have multiple borrowers that you work with. So we want to make sure that we're setting you up for success. And by setting you up for success, your borrower is happy. But it really starts with you and what you're sharing.
Awesome. So final question, what's something lenders rarely get the chance to say to brokers, but wish they understood?
Read the documents that you're sharing. Look at the property. Look at the property. You know, it's easy to fight when appraisal came that the property was supposed to be worth $500,000 and the appraisal came back at 450. And well, we could fight that. We'll fight that with you. We'll make sure that we'll see the AMC. But you know, why do you think it's worth 500? Like, show me a comp or tell me that. Don't just say that my borrower says it's worth 500, so it should be worth 500. Well, no, show me a comp. Well, this comp sold for 600 and it had a pool, so ours doesn't. So we could take a 50. We can work through a lot of the issues together as a team collaboratively. I like that word a lot. You mentioned it earlier. We're on the same team here and we want to get deals done. So I think having really going through and understanding what you're sending and sharing goes a long way and saves a lot of time.
Yeah, and I'd say understand that miscommunications can happen. I was just out of town last week, or I took some time off, had family visiting for the rodeo. And so I'm a little behind the 8 ball here and catching up with things. And I understand everything is urgent, but I would say just keep a professional tone. There is nothing more, and this isn't an official blacklist, but I get very defensive of our sales team if I have a client who is getting very disrespectful. But then they get on the phone with a management team member and the tone seems to shift very significantly for how they're speaking. But don't necessarily, how I touched on, don't impose unrealistic expectations that you've set then on us as the lender, and then get upset when we can't meet the expectations that we never set and that you then kind of put in place yourself. So that's a big thing that I see in particular, I would say, with those of just kind of some good etiquette goes a very, very long way in this space. And real estate's huge, but at the same time, it's also quite small. So it is something to keep in mind for them.
That was awesome. Thank you for everybody who joined, and thank you, Gabby, for moderating. I thought that was a lot of good points that was shared.
Yes, absolutely. Thank you, everyone. Thank you, Sami and Alesondra. It was a lot of valuable information that we both shared today for our brokers. We will be sending this recording out, everyone, so make sure to look out for that. Other than that, do we have any other final thoughts, Sami and Alesondra?
I think that's a wrap for this Fine Tuesday. I would say the habit that we said of something to do, y'all are doing it by just participating in webinars like this and just trying to learn more and understand kind of how we navigate. It's just going to serve you in the end.
I like it. Well, thank you. Thank you all.
Thank you, everyone. Have a great day.